In this video, I'm going to tell you exactly where you should invest your money in 2019. This is one of the most important decisions you can make in your life, but so many people spend so much time trying to make more money from their careers, and they don't spend very much time thinking about where to actually invest money, but that's your leverage. Invested money is what's going to really change your life in the future. So it's really important that you actually think about this and not just turn your money over to some money manager or delegate it as someone else's responsibility. We're going to start off in this video talking about the possible options, and then at the very end I'm going to give you my absolute number one, or actually there's two of them, two places where I absolutely believe you should be investing your money in 2019. I'm John Sonmez from BulldogMindset.com, and on this channel I teach you how to develop the mental toughness, the mindset that you need in order to succeed at life. I actually retired at 33 years old, became a millionaire, and became a multi-millionaire a couple of years later using these exact principles. So let's crack right into it here. What are the possible investments that you could invest in? I'm going to try to cover as many of them as possible. I have a large amount of money that I'm trying to manage, and I want to get a good return on that money. I want you to go and click up here. I've got a poll up here. Let me know, do you think it's a good idea to invest in cryptocurrency? Okay, be honest here. Don't lie, okay? Before you watch the rest of the video, I want you to tell me yes or no, do you think this is a good idea or not? Let's talk about cryptocurrency, okay? Let's talk about why this is not an investment at all and not a good investment. An investment, okay, my definition of this is something that has a return. Not might have a return, something that has a return. An actual investment is something that has value right now and has the return. You're not waiting for a future return. A speculation is something that may have a return. When you put money into things, right, what a lot of people call investing, I say you're either investing or you're speculating. If you're investing, you've got something that has a return. So let me give you a good example of something that is an investment. Suppose that you bought a stock that paid a dividend. You bought that stock and you know that the next quarter it's going to give you a 4% dividend. It's pretty much guaranteed. It has a value to it. The better the return, there's always a risk still, but the better the return in relation to the risk, the better the investment. The best possible investment is an investment that has an extremely high return and has very, very little risk. Speculation would be if you bought a stock because you think it's going to go up. Okay, there's no return right now. It doesn't pay a dividend. You're counting on the future that it's going to go up. When you're doing cryptocurrency here, this is what you're doing. You're doing speculation. Why? Because cryptocurrency does not actually have a value, okay, of return on it. It has a value that it's currently trading at, okay, and you're hoping that it is going to go up. Hoping is not investing. It's not a good strategy. Have people made a shit ton of money investing, quote, investing in cryptocurrency, speculating in cryptocurrency? Yes, they have. But people have made a lot of money betting on a number on the roulette table and having that number come up. Don't get me wrong, I like cryptocurrency. I think it's gonna go up. I think so, okay, but I don't base my investments on what I think, because when I'm wrong, I don't like to lose all my fucking money, okay? So that's why you should not do this. Could you speculate a little bit in cryptocurrency with some of your money? Sure, it might be worth a long shot, but it's not something that you should rely on. If I were to invest in cryptocurrency, I would not invest in the actual currency. I would invest in businesses and technologies around cryptocurrency. That would be a little bit smarter in my mind. Now, in this case, we're sort of getting into more of an actual investment. Realistically, these things by themselves are not investments. We're not getting a return, a guaranteed return on these things. This is what most people do. You get a job, okay, you contribute to your 401k, your company matches, and you invest it in mutual funds in the 401k. You're going to invest the money, compounding interest is going to increase that money over time, and you're going to retire someday. MJ DeMarco talks about like the three lanes, right? The slow lane, the medium lane, and then he had the fast lane. The problem he said with the slow lane, which is this, is like, yes, compounding, the magic of compounding will eventually make you rich with a small investment over time, but it's going to take you like 30 to 40 years. And even then inflation happens, so you're not really that rich. I mean, if you have a couple $1 million when you're, 65 or 70, The utility value of that is very low, and you had to do a lot and sacrifice a lot. I don't like that. I don't like that. He doesn't like that. It doesn't make sense. That's why I don't consider that a good investment. It's going to take you so long, and you're still dependent on circumstances. You're still, it's still not really an investment. It's still speculation to some degree, because you need the market to go up. I think a lot of people say, oh, this is low risk. It's not low risk. The market could take a hit. We could have really bad things happen to the market for a period of time. Yes, over time, maybe these things average out and have a few percent return, but come on, okay? Even if you get 6 or 7% return here, which, believe me, after the fees and everything, when you actually calculate it, your return is not that. It's not the best choice. Now, here's the problem with stocks. All right, which stocks are you going to invest in? All right, if you just do a straight investment strategy, if you're just going to pick some stocks, the problem is that you're not going to have it diversified very much, and again, you're speculating. There's two strategies. I suppose if you buy dividend yielding stocks, then you're not really speculating as much. But if you're just buying stocks and waiting for them to go up, that's speculating, and they could go down, and you can lose a lot of money in the stock market. So not really a great idea. Now, if you buy dividend stocks, that's not a bad idea, but here's the thing. What are you going to get for dividend? Maybe 4%, maybe 5%. If you get higher yields than that, you're going into very risky stocks, right? I'm not saying there's not dividends that pay higher, but for blue chip, kind of stocks, you're looking at this, at kind of the best, and it's not guaranteed. I mean, sometimes they reduce dividend, and if the stock price goes up, obviously this percentage is a function of that, so it's lower. Not necessarily the best thing here, and here's the big problem with it, is what happens when you make this 4 to 5%? Well, you got to pay Uncle Sam on that, so taxes. And the more money you make, the more that this capital gains is going to cost you, right? If you do short-term capital gains, you're going to be screwed. If you hold on to it for a long enough time, which requires you to lock up your money and to risk, this yield going down or the stock dropping in price, right, where you can lose your initial capital, then you are still going to pay long-term capital gains. But if you make a lot of money, right, that capital gains is actually higher, right, based on your income. Even though because you have a state, if you live in California, there's some variables there as well. This is the first one where I'm starting to say, okay, if you really don't want to put any thought into this, and you're just going to put your money somewhere, okay, I can see this. Most people are saying, well, historically, I'm going to get a return of 6 to 7%. You're diversified there, so you're not taking as much of a risk there, right? It's probably a good, solid investment. This becomes an investment rather than speculation because you're looking over the long haul, and we've got historical data that says that this is going to go up, but that doesn't guarantee it. The stupid thing here is taxes. Sucks. Taxes, taxes, taxes. Now, you could do this in your 401k, and then you could defer the taxes, right? That's fine, but again, you're waiting to a 65. If you didn't have the taxes, this would be great. This would be a lot better, okay? Because you could get a decent return on your money. If you had $1 million, you're gonna get 60 to 70K a year, okay? That's not bad. That's not bad on your $1 million. We'll go through this one quickly. What is the return right now on CDs? It's like 1%. Or like maybe 3% on a long-term one. I would do treasury bills or CDs if I had like, $20 million. Because it's so easy, because you're just gonna get this return, and it's, if it's treasury bills, it's tax-free, and then you can live off of this pretty easily like a king, and your principal never goes down. But it's not a smart investment. It's just a hands-off, easy investment. So let's kill this. This is not bad. These you can get like some yields of like 4 to 5%, but tax-free, right? Maybe even a little bit higher if you go into the junk bond. It's not a great idea. Here's the problem with this. These can be defaulted on, especially when the government leans left. A more fiscally conservative government is going to have less of the defaults, okay? When you're spending a lot of money on government services, that's how you end up going broke, okay? Because you're not going to get the income that you need. So you're taking a risk here. You're rolling the dice. It's a great return. I mean, if you have even like, if you have a couple $1 million, you're going to, passive hands-free, you're going to have to find these, right? So, and you're going to want to diversify. So you're going to have to find multiple one of these. It's going to take research. It's going to take time. If you got a lot of money to manage, it's going to take time to do that. The second thing about this is like I said, if it defaults, you lose it all. You're not getting like a super great return, but you know, if you look at this, it's equivalent to like a 6, 7, 8%, depending on where your tax bracket is, if it weren't tax free. So that's good. If you're going to do this route, I would probably find a tax free municipal bond fund. Okay, there's funds. Okay, that means what they do is they buy like 100 different ones, and it's diversified. It's like the S&P 500 index fund. So this is a good if you find a fund. With the fund, see this 4 to 5% return. Now you're looking at 3 to 4%. There, now you've just lost all the kind of benefit from that. Again, if you have like maybe 10 million, sure, that's fine, because now you can live off of this 4%. Pretty damn easy. Very low risk of having something happen. I mean, still the bottom could fall out of the municipal bond market completely. But if that happens, you know, a lot of people are in deep. Let's get to some of the good stuff here. All right, so you see kind of the downsides of this stuff. Let's look at real estate. What kind of returns can you get on this? Like, let's look at solid real estate cap rate deals. With real estate, if you are willing to do the work, you can find cap rates. Okay, this is basically your return, your percentage return. It's an easy way of saying this. Okay, you can find like stuff that's 10% to even 15 or higher than that. If you find sort of properties that are in not the best areas, that need some TLC, if you're hunting for deals and you do that kind of legwork, you can find that if you want. That's a bonus if you want to do that. Now, I don't want to do that kind of stuff, and I don't want to manage some nasty properties where you're going to have problems. Like, you're going to earn this. It's not going to be very passive. You can find other cap rate deals, okay, like really solid stuff on the other end of the spectrum. Like, we're talking commercial retail, we're talking, you know, apartment buildings, we're talking, you know, just A-class properties, even single-family homes where it's really solid, okay, where you're not going to have problems and issues and whatnot, new construction, things like that. Let's say 5 to 6%. Okay, depends on your market. You know, it's not, you're going to find that in San Francisco, you're not going to find that in New York City, but you find that in the Midwest. You find that in a lot of markets. This is a reasonable. John, that's not very good. Like, I want to get like 10%, 20%, like if I'm going to do real estate, we've got to look at more than just this return here. Again, if we had $1 million, all right, we just bought something cash, all right, we're getting 5% return, we're going to get $50K a year. Not a huge amount. If you got $3 million, you can live off of that nicely. If you just bought something cash, and you got this, that's great, but here's what else you're going to get. Appreciation. Now again, this is the speculation part of it, but if you hold on to something for 10 years, some real estate, it's going to go up. So maybe you might get another, maybe like 2% to 3% appreciation per year. So this 5 to 6% actually becomes more like something like 7 to let's say like 9%, something around there. Basically with real estate, 27.5 years, you can depreciate the building component of the real estate. Let's say you had a house that was worth 110, okay? And 10,000 was land and 100,000 you said was the actual building. You could take 100,000 divided by 27.5 and you can basically take an income deduction, right? Depreciation and expense. You're depreciating that asset of evenly divided over 27.5 years. I don't have a calculator here, but you can calculate that out. If you're in a high tax bracket, like if you're in a 39% tax bracket or whatever, then this depreciation is worth more to you. Now here's one other thing that you can do with the real estate. You can leverage it. So what do I mean by leverage? So what if let's say we have $1 million, but you know, I'm using big numbers here just so you can see how this scales up. With residential real estate, you could do like a 20% down payment, right? When I was doing some of my first properties, I was doing like 10% down payments and paying a little bit more, so I was highly leveraged. But the power of leverage, okay, even just without the leverage, this is why I'm saying real estate is such a good deal, is because even if you just buy it cash without the leverage, all of this makes your percentage much, much higher than any of the other things. Now, this whole appreciation basically is ×2, because it's doubled, because you're getting appreciation on a larger property than your investment. Does that make sense? You're investing $1 million, but you're getting the appreciation of doubled. So, you know, if the property goes up 10% in value, you get a 20% return on your money from the appreciation because you're leveraged, because you're using half of the bank's money, you're still getting the appreciation on that. Okay, you're paying some debt service on that, so it's going to cut into it a little bit because you're going to have to pay that mortgage. Same thing happens on depreciation. Your depreciation is ×2 as well because you have a bigger property. This 100,000 is now a 200,000. So you're going to take a bigger chunk of it for depreciation. If you're leveraged with 20% down, so 80% leverage, this is a 5x multiplier, right? So you could take this appreciation and takes it times 5x. Now you're going to pay more debt service, so you're going to have less cash flow. It's going to be more money that you're putting into the bank of the principal paid on the property. You can get up here with that, with leverage, when you consider the principal pay down, okay, and you consider all these other things and the appreciation multiplier, you can easily, with real estate, be in the 15 to 20% and higher. So far, this is the best investment. Not only that, here's the other beautiful thing about this, is that you can do what I'm doing right now, which is called a 1031 tax deferred exchange. When you sell the property, you don't even pay the capital gains tax. You defer it and you buy another property. Now there's some rules, I'm not going to get into all of that, but essentially you can take this one little property, you can turn it into this big ass property and not pay the taxes, basically defer the taxes, so that you can keep on rolling that money up, and that's good. Okay, now if you never actually ever cash out, if you just keep on doing 1031s and you just hold on to the property, guess what? You never pay the taxes. So that's one strategy. You're just collecting that cash flow and you're developing passive income. That's why real estate is so good. Now there's one other thing I'll tell you about. You should be investing in real estate, absolutely, okay, because of those reasons. And there's a lot of ways to invest in real estate. I've got, if you haven't already, click that subscribe button. I've got a lot of information on this channel. Okay, I'm an active real estate investor. Okay, but there's one last thing I'll tell you about, which is you can invest in your own business. Now, this is probably the highest return thing that you can do. If I had two things that you should invest in, okay, especially if you're young, all right, business and real estate. Now, why do I say that? Investing in business is how you're going to make that $1 million. Don't do the stupid thing. Okay, this is a stupid thing that people try and do. Is they say, okay, let me invest my little $10,000 and hope I get rich someday. Even if you invest this in real estate, do you know how long it's going to take you? Yes, you're not going to be in the slow lane, but you're going to be in the medium lane. This was my original strategy. It worked out, but I could have been retired and much sooner, been a millionaire much sooner, okay? Because it just takes too damn long. Compounding takes too long. Start the compounding at like 500K. Start the compounding at least at 100K. Don't even worry about this shitty small amount. Don't even invest that shit. It's not even fucking worth it. It's not worth your time. It's not worth the effort. Go big. Should have waited till I had more money and took this money and said, small amounts, invest here in business. Because business can get you 1,000% return, okay? Business can get you 1,000,000% return in some cases. Now, it's probably not going to get you that, but this is reasonable, okay? If you learn how to create a business, how to start your own business, this is what you should be doing, is you should have the goal of making a big chunk of money so that you can put it here and get passive income right away and get those big returns where it makes sense. Even if you didn't do this, even if you said, no, John, you know what, I want to do S&P 500, good. We'll start with 500K. Start with at least 100K. Start with something big. If you look at the compounding schedule of like investing $10,000 or $50,000, by the time you actually got to 100K, you know how long it would fucking take you? It would take you a really, really long time. Just skip all of those years and don't waste that time and that effort. Instead, take this money, try to invest it somewhere here in your own self, in your own business, and building a business where you're going to be able to make a much higher multiplier so that you can start at a bigger point. You can jump ship, you can jump to the place where the interest actually makes sense and actually makes a difference. What's the kind of trade-offs there, right? So basically, it's a factor of risk, it's a factor of passivity, okay, and it's a factor of the yield. This is kind of my wealth triangle, which is basically return, okay, cash, and time. You pick two of these things. Or you only need two of these things to make a lot of money, okay? If you start off with a lot of cash, right, you just need like either a lot of return or a lot of time, okay? If you start off with $1 million, you don't need much of a return if you got a lot of time. If you get a big return, you don't need much time, okay? If you have a very high return, okay, you actually don't need much cash, but you do need some time. I'll do a future video that explains all this in detail, but that's the thing that you need to consider with this. Best investment, if I were to give you, would be invest in your business, in yourself, and real estate. Thanks for joining me. If you have any questions, any comments, leave them below. Leave a thumbs up. And I'll talk to you guys later. Take care.